All right. So why don't we start with a very brief review? Last class we were talking about theories of exchange rate determination. So we're talking about currency markets. And we talked about one factor that's related to exchange rate determination, which we summarized under the name Purchasing Power Parity, or PPP. And I guess the bottom line of thinking about PPP was that if you're a country that experiences higher inflation than another one, then sooner or later your currency should lose value. So inflation makes currencies depreciate, and that is, of course, based on considering that one of the reasons why you might want to obtain a foreign currency is in order to buy goods or services from that or from a place that uses that currency. And we found that PPP works in the sense that you can use it to predict what's going to happen to currencies, to currency exchange rates, but it takes a long time, maybe several years, before inflation seems to affect exchange rates. And moreover, well, except in extreme cases. So if you experience 8,000% inflation, your currency is going to lose value now, most likely. But what that tells us, of course, is that there must be other factors that affect exchange rates on a shorter time frame. And since PPP comes from thinking about the fact that one of the motives for getting hold of foreign currency is to try and get hold of foreign goods, what that suggests is that maybe we should start by thinking of other motives why someone might want to get their hands on foreign currency. So going back to last Wednesday's class, we should remember what some of those motives are. They're written in the bottom left-hand corner. One of them was to get hold of goods and services. But broadly, the other thing that you might want to buy in another country other than stuff is assets. So, for example, let's think about, when we were thinking about how risk affects asset prices, for example, we were thinking, okay, let's imagine two kinds of assets that are the same in all ways except in risk. So let's try and think about two assets that might be available in two different countries that are similar, except for the fact that they're in different currencies. And a classic example are, of course, government bonds. Remember that we were taking them as sort of a benchmark asset because whatever else is going on in an economy, at least for major economies, the government is not going to default on its debt, or at least it's highly unlikely to do so. And so let's pick two countries, let's say United States and Japan, and think about the incentives that someone might have to buy government bonds in one place versus the other. We know people do this. You may remember from our discussion of Nick Leeson that his job was to sit in his office in Singapore and buy and sell Japanese government debt. So let's say I'm a bond trader and I work here in the United States, and I'm thinking of getting United States government bonds, and if I buy them, then I get some interest. And let's call it I sub US. So I sub US is the interest rates I can collect on United States government bonds. Now my alternative, let's say, like Nick Leeson, is to buy Japanese government bonds. Now, to buy US government bonds is straightforward. I have a bunch of dollars. I just need to go out and buy the bonds. But if I want to buy Japanese government bonds, things are a bit more complicated. Because first, I have to, before I can buy Japanese government bonds, the first thing I have to do is to buy Japanese currency. Only when I have the Japanese currency can I then go and buy the Japanese government bonds. Then I have to wait until maturity, get paid, and then, well, I'm based in DC, so I have to then take the payments that I got in Japanese currency and convert them back into dollars. So it's a slightly more complex operation. And what it means is that if I pursue this alternative of buying Japanese government debt, my return is going to have two different parts. One part is, of course, whatever interest rate the Japanese government is paying on its debt. But that's not the only one, because in order to buy the Japanese debt, remember, I first had to buy Japanese currency, and then in order to get it back in dollars, I have to sell it again at the end. And that means that, first of all, the exchange rate matters. And second, the exchange rate matters twice, because I have a certain exchange rate when I buy the government, sorry, when I buy the Japanese currency, and then a possibly different exchange rate when I sell it. And so, in addition to whatever interest the Japanese government pays me, I may also gain if it turns out that the Japanese currency gained value over that period of time. So in this case, I get both the interest and any expected appreciation in the Japanese currency. Okay? So in one case, I just get the interest from the United States. In the other case, I can get two things, the interest from Japan and expected appreciation in the yen. Okay. Now, what do you think is going to come next? I am a bond trader, and I can do either one of these things. I will do whichever one I think is more profitable. And the same is true not just of me, but of all the other bond traders out there. So what do you think that implies about the relationship between this interest rate over here and this exchange rate adjusted interest rate over there? If you use any sort of, whenever we think of asset prices, we often end up using these no arbitrage arguments. The only way you could avoid arbitrage in this situation is if these two things are equal. So this is another theory of exchange rate determination that's, again, based on the idea that people are buying and selling assets. We're specifically focusing on government bonds because they're similar, right? They're both riskless, and so we're comparing apples and apples. And this theory of exchange rate determination is not called purchasing power parity. Instead, it's called interest rate parity. So how do we think about this? One way of thinking about it is, suppose you observe that the US interest rate is, let's say, 4%, and the Japanese interest rate is 3%. In general, whenever we were talking about asset price determination or interest rate determination, you may recall that usually when an asset, has a higher return than another one, it usually means that there's something wrong with it. There's some aspect of it that's not appealing to investors that means that they won't buy it unless they're promised a higher return. In this case, why might it be that the US interest rate is higher than Japanese? Well, they're both risk-free. So since the US interest rate is higher, there must be something, so to speak, wrong with it compared to the other one. The only difference between them is that they're in different currencies. And so the bad thing of the US dollar, or the good thing about the Japanese assets, is that you think the dollar is expected to lose value, or equivalently, that the yen is expected to gain value. And so that's the bad thing, so to speak, that makes this interest rate higher than that one. And in particular, it would have to be specifically, these are supposed to be bonds of the same maturity, so specifically, over that period of time, you'd expect the yen to appreciate by about $1. And that forecast is built into all of this. Okay? So that's interest rate parity. Any questions, comments? Now, this is something that, of course, you could try and predict, right? You could take, if you're a senior and you're looking for a project, for example, for your thesis, you could get, let's say, 1 year interest rates for US bonds, and 1 year interest rates for Japanese government bonds. And then how can you figure out how much people expect the yen to appreciate? Well, how about the 1 year ahead futures contracts? You can see if, let's say, the 1 year ahead futures contract is 1%, has a 1% higher exchange rate than now. Well, that tells you what the expected appreciation is, right? Compare the forward and the spot rates. And you could use those data to try and figure out, is this theory any good as a way of predicting how exchange rates are determined? Now, I tried to do that this morning, but I couldn't actually get the data I was trying to download the data and I couldn't get them all to match up in time, so I haven't done it. But again, if you're an enterprising senior or junior, you may wish to try. But needless to say, of course, economics professors like me don't just teach, we also do research. My research is on a different topic generally, but there are people who have done exactly what I described and try and see whether interest rate parity works as a theory of exchange rate determination. And just as PPP works as a theory of exchange rate determination, but only if you give it long enough, let's say, so 2, 3, 4 years, interest rate parity also works, but only at certain time frames. So it seems to work maybe for 1 year, 6 months forecasts, but for shorter, for shorter forecasts, it doesn't seem to work. So again, or at least it doesn't seem to work as well. So what do we need to do then? Well, what did we do when purchasing power parity didn't work? We thought of other motives. We said, how about bonds? So what's the next logical thing to consider? Maybe it's not bonds that you're trying to buy across borders. Maybe it's shares. What about shares? Well, your intuition might say, well, we could do something equivalent to interest rate parity with shares, right? Except that instead of this being the interest rate on US government debt, it should be the expected rate of return on equity in the United States. And then this, instead of being the interest rate on Japanese government debt, it could be the expected rate of return on shares in Japan. And then this would be the same thing, expected appreciation of the yen. And then what you would be doing is that you'd be a stock trader, and you're comparing the idea of investing in US shares or buying Japanese yen, investing in Japanese shares, and then at the end of the year or whenever your investment horizon is done, you convert it back into dollars. So you could imagine trying to do that. But then there's a problem. Remember, or at least there's an issue to overcome if we wanted to do something like that. Well, there are two. One is a practical question about how to measure it, because it would be might be hard to figure out what's the expected rate of return on assets on shares over some period. Although you could probably figure that out by looking at stock futures. The second issue, which is not a practical one, it's a theoretical one, is, remember when we were talking about interest rate parity, I took great pains to say that we're comparing apples and apples here. The US government debt and the Japanese government debt are riskless, so the only thing that separates them is the exchange rate. Is that true of shares? Are shares in the United States equally risky than shares in Japan? Not obviously, right? But then think back to the midterm and think back to a bit before the midterm. Remember we had some discussion, and there was a question about this in the midterm. I think it was question 30, about the principle of diversification. Now, the principle of diversification came up twice in the midterm. One was just generally what's the idea? Right? The idea is that there are lots of shares. They each have their own idiosyncratic risks, and they also have systemic risks. If you hold a whole bunch of them, then in the right amounts as well, then the idiosyncratic risks will offset each other, and the only thing you'll be left with is systemic risk. The second time it came up in the midterm was regarding the question of why is it that when we're trying to discount dividends according to the generalized dividend valuation model, why is it that we use a single discount rate on equity instead of using a different one depending on how risky you think the stock was? And the answer was the principle of diversification. If you're holding a balanced portfolio of shares, none of their idiosyncratic risk contributes to the risk you face. The only risk you face is systemic risk, and that affects all of them equally by definition. So there's only one discount rate for equity. Now let's take the position of someone who's holding shares in the United States and Japan. The question was, are the shares in Japan riskier than the shares in the United States or vice versa? Let's approach it with the same argument. If you're holding a well-diversified portfolio that includes both shares in the US and in Japan, this diversification argument should apply there too. Since you're holding both, you're not just not facing idiosyncratic risk from each of the US shares and each of the Japanese shares. You're also diversified against things that might help the US and hurt Japan, or vice versa. In other words, you've diversified even better than before, right? Now the only risk that you face is not the systemic risk of the US or the systemic risk of Japan, it's only systemic risks that affect both of them. So by the same argument, they're both equally risky as far as you're concerned, because you've diversified away everything except the systemic risks that affect both the US and Japan. So what does that mean? It means that, well, I asked the question, can we do the same with expected returns on shares? And the answer is yes, because we're assuming that you're well diversified in both markets and across the markets. And so therefore, the only risk that affects any of your shares is the joint systemic risk of the US and Japan. So we are comparing apples and apples. That was the whole point. Any questions, comments about this? Yes, just a second. Yes, Marshall.
So the principle the principle of diversification, I can't say that word, it's just an assumption, right? How often does it hold in reality?
So, I mean, it's an assumption. I mean, if it's a theory, so, but of course it is practical. So if you go to, I mean, if you ask, if you had, well, let's say, I manage my parents' portfolio because they don't know anything about finance and they also don't live here, but their money is here. And so whenever I go and talk to the financial advisor over at Wells Fargo, they never say you should buy GameStop or you should do this. It's all about diversifying. So remember, there are safe assets like US government debt, and of course those give you a very low return. And then there's the stock market, which gives you higher return, but of course has more risk. And so what you actually do in practice unless you're like an active stock trader, is you're trying to figure out how much of my portfolio should I put on the risky thing and how much should I put on the safe thing. Then you just choose a point in between that fits with how much risk you as an individual are willing to take on. Okay, but the point is, in practice, most financial decisions are made following this idea, rather than, as I said, just buying one share and thinking that it's going to go up. That's a pretty risky strategy unless you're a highly informed individual who makes a living by doing research on things like this. Are there people that do that? Sure. There's this guy called Warren Buffett. I'm blanking on what his company's, Berkshire Hathaway, his company's called. And what they do is they do this kind of research and they buy a few companies and hold on to their shares with the expectation that they will rise and that they will beat the market. By which I mean get a higher return than you would if you just held a well-diversified stock portfolio or some mix of stocks and bonds if that's too risky for you. But it's very hard to beat the market. Certainly very hard to beat the market systematically. So as a practical matter, it is something that's commonly used. I guess if I said that there would be a fairly straightforward way of studying this in the data, you just need to get the interest rate data, and then I guess you could use spot and futures exchange rates to get what the expected appreciation of the yen is. I guess the same thing could be done to check this, right? If we want to give it a name, I guess we could call it equity return parity or something. It might be a bit harder because you need to figure out what are the expected returns on shares, although I guess you could do that if you had an appropriate futures market in the US and Japan. But in the Blackboard website, I uploaded a couple of papers that propose and study this theory. And essentially what they find is that it does seem to help predict, you can use this to predict exchange rates at a shorter time frame, let's say a week or a month. than this. So the conclusion is it seems that different theories work for predicting exchange rates at different time frames. And I guess the interpretation is over the long term, goods and services matter and trade patterns may be affected by exchange rates, so PPP works. At very short time frames, like a day or a week, you have this money that's running around across the world trying to make a quick gain, like Nick Leeson at Barings Bank. And so money chasing profits from equities predicts exchange rates at short time frames. And in the middle, we have interest rate parity for, again, 6 months, 1 year type of predictions. And that's my understanding of how the empirical literature has found evidence for these. Can I repeat that? Sure. As discussed, PPP works, but it takes a long time, and that kind of makes sense because trade is one motive for getting currencies, but again, the prices of goods and services need to be quite different before PPP starts to work because there are these transportation costs and so on. So instead, at shorter time frames, we have these two theories. And it seems that interest rate parity works for slightly shorter time frames, like 6 months or a year. And for even shorter time frames, I guess rate of return parity seems to be useful for predicting exchange rates. And I guess what that tells us is that a lot of the money that's sloshing around across borders in the currency markets on a day-to-day basis, what they're really doing there is just trying to make money off the stock markets in different countries. All right, so let me save this. That whole discussion was about, and actually our discussion last week as well, is about assuming that it's market forces that are determining the exchange rates. But as we were discussing before, it's possible that maybe there were some countries. So this was for flexible rates. But what if they were fixed? More generally, it may be that governments try and do something or other to the exchange rates for purposes. Let's just take the extreme case where the exchange rate is fixed. And once we've looked at that example, we'll be able to think about the more general case. Okay? And you might wonder, well, first let's talk about how you do it, and then let's talk about why you might do it. So in order to talk about exchange rates that are fixed or otherwise controlled by governments, there's going to be a very useful notion, which is that regardless of what the government is doing, there must be, behind the scenes, something that I'm going to call the fundamental value to the currency, which is, so to speak, the value it would have without government intervention. Why do we need this? We need to imagine what would happen if the government were not trying to fix the currency. You might think that there's nothing to stop the government from saying, let's say, I order the let's pick an example. Let's say when I was growing up in Peru, the currency was called the sol. So imagine the government just says, I declare that $1 equals 100 soles, and that's it. You could imagine something like that, right? But think about whether that would actually work. I mean, suppose the government, so here I'm holding a bottle of green tea, and suppose the government declared that this bottle of green tea is worth $10. Well, what about the person who makes it? It costs them maybe, let's say, $1 in materials and labor to make it. and they can profit handsomely by selling it for $2, which I'm happy to buy it for, whereas for $10 I wouldn't want it. So everyone involved in the market for this team has an incentive to just go ahead and get it for whatever the market price is. And the government can declare that it should be worth $10, but that declaration is meaningless unless we actually use that price to transact. And you might think, well, what if the government says that it's going to put you in jail if you don't follow the official price? My experience growing up is that that doesn't work. I think I may have mentioned this in another class, but at some point the government in Peru declared that the currency had some value, let's just say 100 per dollar. But there was a street in Peru where there are people standing around with calculators, and they would just tell you what the rate was. And the rate was usually much lower, actually, say 200. The government had picked a fixed exchange rate that didn't bear much relation to the fundamental value of the currency. People, even though there was a threat of jail if you got caught, people were still ignoring the official rate and just going about their business with on the black market, the illegal currency markets. And I've seen this in China as well. When I was, a few years later, I visited China. I spent the summer there, and officially the currency of China at the time, the renminbi, the people's currency, was it was illegal to exchange it for foreign currency, for dollars. Now in reality, so the way it worked was, if I as a tourist arrived in China, there was this other currency called Yuan, which I think means foreign exchange certificates. And I was only allowed to convert dollars for those, and the exchange rate was something like 5 per dollar. But it turned out that there was a black market for the people's currency, which had a different rate. It was about 9 per dollar, I think, at the time. And you just needed to find someone who was willing to exchange with you, and you could do it, even though it was illegal. So you just go to the flea markets, and some of the people that sold clothes and whatnot in the flea markets, if you hinted that you would like some foreign currency, they'd just take you around the back where you can't be seen, and then you'd exchange currency and so on. So what is the point? The point is that fixing a currency is very hard to do by decree. You can't just say the sol is worth 100 or whatever. You have to play by the market's rules. In other words, if you want to raise the value of your currency, you have to buy it up in some sense, or somehow make it more attractive or increase its value by using market forces. So let's do an example, not the sol, but rather the Argentinian peso. That's going to be useful because at some point, not lately, now the exchange rate is a bit different, but at some point there was a rule that said that 1 peso, the currency of Argentina, equals $1. There was a fixed exchange rate. How do you maintain it there? Well, suppose that something happens that would make the peso lose value. If you're the central bank of this place, you have to play by the market's rules. So in order to keep this fixed exchange rate, so to keep the exchange rates where it is, you would need to bid up somehow the peso. So intuitively, you'd like to buy it up somehow. And if you want to buy your currency and you're trying to do it in a manner that's going to affect the exchange rate, what are you having to provide in exchange? You would have to be in exchange for US dollars. Or equivalently, what you're doing is you're trying to make the dollar cheaper by dumping dollars into the foreign exchange markets. It's the same thing, right? If you're buying one currency, you're necessarily selling the other one. Okay? And similarly, what if something happens that would make the peso gain value? Then you would have to do the opposite, right? To keep the exchange rate where it is, you need to try and push down the value of the peso, which means buying up dollars. All right? Now, in each case, this is implying that you, the central bank, in order to keep your currency value constant, you need to have a stash of dollars, right? You wouldn't be able to do this otherwise. So, in general, all central banks have a stash of various foreign currencies. We're going to refer to them as their currency reserves. Okay? So to sum up, how is it that countries fix their exchange rates, or more generally try and affect their values? They need to have this big stash of currency reserves. If they want to raise the value of their currency or to stop it dropping, same thing, they have to bid up their currency, which means they have to sell their currency reserves. On the flip side, if they want their currency to lose value or they want it not to gain value, they have to do the opposite. They have to increase their currency reserves. And so that stash of money will shrink and will grow or shrink depending on which kinds of shocks their economy is getting, the kind that makes the currency lose value or that would make them lose value or that would make them gain value. All right, so the bottom line is force doesn't work very well as a way of enforcing currency values. You have to use the market and the way you do it is by having this stash of currency reserves that you adjust in order to keep your currency where you want it to be. Any questions or comments about this? If not, the next thing to discuss, I guess the last thing for today, is how this can go wrong. So let me again indicate the currency reserves as a big box. That's your stash of foreign currency. And go over something that we just discussed and try and bring out a few more elements. Remember, your currency reserves increase under some circumstances and decrease under others. So let's try and get that straight. When trying to raise the value of a currency, well, if you're trying to raise it or stop it from dropping, you have to bid up that currency, which means you have to sell foreign currency. So the reserves will decline because you're selling foreign currency. And the opposite, when trying to lower the value of a currency or stop it from rising, it has to be the opposite, right? You're accumulating foreign currency reserves because you're buying foreign currency. To make it more valuable relative to yours. All right? Now, at this point, maybe it's worth wondering, why is it that you might fix your currency in the first place? And I'm going to give you 3 reasons, the latter of which is going to connect back to this discussion of the Argentinian case, and which is also going to connect with how things can go wrong. So why would you fix currency in the first place? One is that, of course, if you look at what currency values do over time, exchange rates, they move around all over the place, right? So if you have a fixed exchange rate, you get to reduce some uncertainty. So that might be one possible gain. The second, and I haven't heard this discussion so much now, but this was something that used to be talked about before, was the idea that many of the investors in the currency markets were what's referred to as speculators. They were making bets on the currencies moving one way or another, and they were doing this in a manner that led lots of people to lose money. So, for example, at some point, the British pound was supposed to only fluctuate, its exchange rate with the euro was supposed to only fall within a certain band. And the pound was losing value, and some investors bet tons and tons of money that the pound was going to fall out its. So it went down to the band of the band, and then the government of the UK, the central bank, is trying to raise its value, which of course means they're using up all their reserves. And who's getting them? Those investors. And then in the end, they ran out and fell, and so the idea is, and lost a ton of money that way as well. So the idea is that there may be some large investors who are moving the exchange rate around, manipulating the exchange rate themselves to try and make money, and if you have a fixed rate, they can't do anything. The third reason, which is a bit more roundabout, but is the reason why certain countries have indeed, and in particular Argentina at this state and at that stage, had fixed their currency values. Notice, if you're trying to raise the value of a currency, you're depleting your reserves, which means you're buying up your own currency. And of course, when the central bank removes currency from circulation, that's actually decreasing the money supply. What about this case? The government is trying to lower the value of the country. They increase their reserves, so they're buying foreign currency, which means they have to print money to try and buy the foreign currency. Of course, that means they're increasing the money supply. So when you fix an exchange rate, you're subjugating your monetary policy to that goal. Right? Now, the currency, to keep the currency stable, you have to increase or decrease your money supply according to what's needed, which means that it's much harder for you to use your monetary policy for any other purpose. So, 3, no independent monetary policy when you fix your exchange rate? Hold on a second. That seems like a bad thing, doesn't it? Why would you want to give up your monetary policy? Well, what if you had to give it up? For example, consider Argentina, let's say, in the 90s and the 80s, along with many other Latin American countries, they experienced very high inflation. The central bank just kept printing money to pay the government bills, and so there was tons and tons of inflation. And so if you expect a country to have terrible inflation, why would you, as a foreign investor, put your money there? So it will get worthless. So in order to attract investors back, one thing you might do is to say, I promise I'm not going to create any more inflation in the future. But how would you make that promise credible? The only way to make a promise like that credible is to tie your hands, such as by fixing your exchange rate. Because then the investors can see, oh, they gave up their monetary policy because now they fixed their exchange rate. So they can't freely print money anymore. It'll go against their 1 peso per dollar rule. So one reason why you might fix your currency is because you're trying to persuade people that you're not going to do anything silly with your monetary policy. Ecuador went even further. They just got rid of their currency altogether. So, of course, they have no monetary policy. Nonetheless, as I've suggested, things went wrong. What can go wrong here? Well, suppose that you're the Argentinian central bank and you said that $1 is 1 peso. Whoops. Unfortunately, the symbol of a peso is that, which is going to be confusing, so that's why I'm calling it P instead, just for convenience. And suppose something happens that means that the fundamental value of your currency would make the peso gain value. Right? For some reason, there's lots of demand for the peso. Then you have to do this. You have to lower your value, right? Or suppose something happens that means that the peso would lose value, then you're in this situation. Right? In one situation, you have to increase your reserves. In the other situation, you have to decrease your reserves. Now, if your fixed currency rate is not very different from the fundamental rates, then some days you'll be increasing your reserves, some days you'll be decreasing your reserves. Like some days you'll be here, some days you'll be there. But what if your fixed exchange rate is wrong? For example, what if you fixed it so that your currency is, its fundamental value is actually much higher than what you fixed? Then you're finding yourself trying to lower the value of this currency day after day after day after day. What's the problem there? Well, in order to do that, you have to keep buying tons and tons of foreign currency. If you keep buying tons and tons of foreign currency, what happens? You're increasing your money supply. And if you keep doing this day after day, after day, what do you get? Inflation. So if you're finding yourself, so if you fixed your currency at a value that was too high, you keep having to print money to expand your reserves, and eventually that'll cause inflation. And if there's inflation, what happens? The fundamental value of your currency goes down, and I guess eventually the whole situation is corrected, but to get there, you had to experience quite a bit of inflation, which is not great. Now, what if you're here, in this situation? You picked a value of your currency, let's say 1 peso per dollar, but the fundamental value of your currency is much lower. Let's say 2 pesos per dollar. then what you're finding yourself is that every day you have to try and raise the value of the peso, which means every day you have to deplete your currency reserves. You keep selling foreign currency, selling dollars to try and keep the peso valuable. And what's the problem with that? The problem with that is that your currency reserves are finite. So if you keep having to try and keep your currency overvalued, let's call it, you keep having to deplete your reserves every day, sooner or later, you're going to run out of currency reserves. And if you run out of currency reserves, what's going to happen? Your exchange rate is no longer fixed, and it will just suddenly, from one day to the next, shoot down in value to the fundamental level. And think about the impact that would have. From one day to the next, suddenly all the goods that you needed to import from abroad have become twice as expensive. If you're an oil importer, all your oil suddenly costs double from one day to the next. Machinery that you might need to import doubles. What have you borrowed from abroad? What if you borrowed you're an Argentinian, but you borrowed in US dollars for your mortgage or for your company? Now suddenly that debt is twice as large. You probably would not be able to pay it. Certainly, what if you're an Argentinian bank? If you're an Argentinian bank, you probably did borrow from abroad in dollars, and now suddenly all those debts cannot be repaid. The banking system goes bust, businesses go bust. It's total economic and financial chaos. So fixing currencies used to seem like a good idea because they reduce uncertainty, avoid speculation, and if you've been a naughty central bank, then giving up monetary policy is something you might need to do to regain credibility. But in practice, there's this risk because if you didn't pick the right exchange rate, then you're at risk of either high inflation or even worse, financial collapse if and when you run out of currency reserves. So there is an institution, as it happens, that tries to help countries when they're in this situation. It's around the corner from GW. And that is the International Monetary Fund, the IMF. One of the things that the IMF does is that if a country like Argentina were in this situation, in order to stop them from running out of currency reserves, they might lend them temporarily and only so that they can adopt whatever reforms are needed to try and fix this problem, this mismatch between their fixed exchange rate and what I'm calling the fundamental value. The IMF doesn't give countries money for nothing. They usually have to commit to some kind of reforms that are going to mean that this problem isn't going to recur. And so the IMF does some other things, but that's one of the things that it does. And so if you didn't know before, now you know what happens in that big building next to campus, next to our law school. Any questions, comments about this? I don't hear anyone. So I guess what that means, since we have about 15 minutes left, is that now would be a good time for our exit quiz. So let's share that window. And as usual, whoever wins gets to put some silly Snapchat filter on me. So now let me see. You should be able to see. There we go. You should be able to see the website for our exit quiz. Let me just try and set it up. I hope it isn't going to decide to fail now. Like a couple of weeks ago, I remember it froze. Wake up, computer. There we go. So please surf over to this website and enter this game pin 4384179, and we'll see who is today's winner. All right, everyone signed in very quickly. That's good. I think there's one more person in the class. Let me double check. No, not that. Sorry about that. I think that's everyone. Yep. All right, let's get started. Today's exit quiz. Question 1. Interest rate parity. The interest rate in the US is the interest rate in Japan plus what? The expected appreciation of the dollar, the expected appreciation of the yen. All right, very good. Most of you got that right. That's good to see. Question 2. Why might you expect the yen to appreciate in the first place? Could it be because inflation in Japan exceeded inflation in the US? Or the opposite? Or was it interest rates are lower in the US? Or is it expected stock returns in the US are lower? All right, 3 of those answers were the opposite of the correct one, so maybe you need to review that part. Good job, TJ. TJ's first. To keep the sol, the Peruvian currency, from depreciating, what does the Peruvian central bank need to do? Should they dump soles? Should they buy dollars? Should it increase its currency reserves, or should it decrease its currency reserves? One more person. All right, most of you got that right. Good job. Sophia's ahead now. Question 4. If this keeps happening, the Peruvian central bank will cause what? A sudden devaluation, a sudden revaluation, its reserves of dollars to increase, or inflation to rise? Which one is it? One second. Okay. Next. Question 5. Before the devaluation, the sol will be worth more on the dry market. Is that true or false? Or would it be worth more in the real markets? Five seconds left. Interesting. That seemed like a hard one. Remember, it should be the fundamental rate is going to be the black markets. Good job, Sophia. Last question. After the devaluation, what would happen? Imports into Peru would be cheap. Imports into Peru would be expensive. Average income of Peruvians would rise, or exports out of Peru would be expensive. The Peruvian currency lost value suddenly, what would happen? 5-second warning. All right, most of you got that right. That's good to see. Let's see how we did. Third place was Alexandra C. Nice work. Second place is Richard. And first place is Sophia. Excellent. All right, Sophia. So, what should I do with my Snapchat filters?
Can you see if there's a cowboy hat?
Cowboy. Cowboy hats. Let's see. I don't know why it's backwards, but does that work?
Yeah, that works.
All right. Great. Thanks, everyone. Hope you learned something. Feel free to call me up in office hours tomorrow if you wish. If not, I'll look forward to seeing you on Wednesday. Take care.